Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor here at Cooper Financial, and your host for today, alongside my co-host Tony Short. And we're back together once again.
The dream team. We're back together. Jacqueline is out today, and I'm back with you, Jose. I miss doing shows together. I love the energy you bring to the shows, and nothing against Brad, but it's like a completely different show when Jose hosts versus when Brad hosts. And there's so much wisdom. I think our listeners benefit from having both of you, right?
Yeah, and Jacqueline, I am gonna miss her today, even though I do like you, Tony. But Jacqueline just brings out the best in me. Whenever I feel down, she just is like, "All right, let's get back up. Let's get going."
She is so good. She was not even hired here to do that job. And she had been here, I don't even think a week. And I said, "You're going to start, my schedule's full. You're going to start co-hosting shows. You'd be great at it." I looked at her and I said, I'm bringing you into the shows. And she was a natural.
Yeah.
Natural. And
I couldn't believe it.
Organized. Yeah, she's great. Yeah, I knew immediately. I'm pretty good at reading people. Which is why I was more than happy to let her record with you. No, I'm kidding, Jose. I'm just racing. But seriously, I do miss recording with you. And Jacqueline's great. Glad to be here. But why don't you introduce Jose? We have a very special guest. And Jose, you're a huge get. You get Jacqueline on as your co-host. And now you've got a great guest, a huge guest for the show today.
Yeah, he's been on the show before, but he's been out for a while. And we haven't had him, I don't know, since probably last year. No, this is Tyler Ellegard. He's one of our portfolio managers over at Gradient Investments. And now he has a new title. Back when we did this show, I think it was in November, October, he was just a portfolio manager. Now, what's your new title? And what's been going on in Tyler's world in the last 6 months?
It's been a whirlwind. Left Gradient Investments for a little bit, went over to be president of our Gradient Advisors company, which is a RIA, similar to Cooper Financial, but did that for an interim period. And now we're back in GI managing portfolios as a senior portfolio manager.
Yeah, moving up in the world. And
they brought him. They had to bring somebody in there to really turn that ship around, and he did that. Now he's back at Gradient Investments. I think that's awesome.
Yeah. I'm going to take a little bit of credit because when I heard that Tyler left, because Tyler, back from the show we did before, Tyler manages the digital discovery, which I'm very much invested in. Yeah. I was very upset, and as soon as
I was upset too.
And I was like, well, when is he coming back? I mean, did he just go forever? And no, but now he's back, thank God. And he's going to be helping us answer some questions that I'm sure everybody has as they've been just watching the news, living. I mean, you can't really escape all this dang headlines and just scared. I mean, I've had a couple of people call me and just asking so many questions and what's next and what am I going to do? And because we have this little correction, and then we had this comeback, this sudden comeback, and lasted probably 2-3 days, and we reached all new time highs, and but there's always some concerns that I have that I want to bring up to Tyler today, and these are the same concerns that I share with all of our clients, but at the end of the day, it's going to be about the way the long-term view of everybody's plan. But I want to get specific about the markets today. And Tyler, the first thing that I want to ask you is, what do you make of this comeback that came back? It just exploded back up. What do you make of it?
Yeah. So it's not honestly that surprising, to be honest.
Okay.
The reason I say that is you have a uncertainty of war between U.S. and Iran, and I think that situation is going to continue to be quite volatile. I mean, it is what it is. And 20% of seaborne shipments for oil goes through the Strait of Hormuz, which is why it's such a big deal. And actually, I just got done writing a piece that should be posted here shortly about fertilizers. So fertilizer is another example of why the markets got so concerned. Is not only do you have higher oil prices, which means your consumers are going to be struggling at the pump. But oil is pretty much in everything. Like Tony might laugh at this, but I always bring up the show Landman.
Oh, I love Landman.
So opening scene for
Billy
Landman, Billy Bob Thornton talks about how we're, 120-year oil-based economy, and it's a global economy as well. So everything in the globe is based on oil at this point. And so all of a sudden you shut down 20% of seaborne shipments. That's a big deal.
It is. Because plastic is made is a petroleum-based product.
Yep.
I mean, in everything.
One that I don't think a lot of people realize too is pharmaceuticals.
Yeah.
Is coated in an oil-based. And then also one that I always like to point out is lipsticks.
Makeup, cosmetics.
Yes.
Yeah, oil-based.
So it's in everything. And all the industries that are bigger than oil rely on oil.
For shipping.
Yeah, I mean everything. And so
transportation.
The reason the Strait of Hormuz is such a big deal is because, and I'll get to the point of the rebound. So it's a long-winded way of answering your question. So 20% of global seaborne shipments go through Strait of Hormuz, and most of that goes to Asia. The U.S. only gets about 5% of our oil from what goes through the Strait of Hormuz, but all of our products that we import comes from Asia.
From Taiwan, China, everywhere.
Indonesia, Malaysia, and they're heavily reliant on that oil. Another thing is helium has been a big deal in like the semiconductor chips recently. Because a lot of semiconductor chips come out of Taiwan, South Korea, and they can't get enough helium because of all of the oil that's being backlogged. They can't get the helium there.
I had no idea.
So, I mean, it just winds into everything. But then you start to think about fertilizers. So nitrogen fertilizer is what's heavily used in farming, agriculture right now.
Yep.
It's one of the best fertilizers out there. About 60% of the product that is a foundation of nitrogen fertilizer, 60% of exports come from the Middle East. So if you think about that, which is now blockaded in the Strait of Hormuz right now.
Yeah.
So Qatar is the second largest behind Russia. Russia has also reduced their exports because they don't, they have sanctions on them. And right. So now you have the number one and the number two exporters of basically fertilizer.
Yeah.
Not exporting right now.
Oh, it's huge. And another aspect of that impact, if I can jump in here, because my dad owns a farm in southwestern Minnesota, huge farming area right on the edge of Iowa, the best soil for farming there is in the United States. And they rotate corn and soybeans. There's some wheat and alfalfa, but mainly corn and soybeans. But the two things they need the most are diesel fuel, which is outrageously expensive right now. You think unleaded has gone up. Diesel has shot up even more, and fertilizer, because we're headed into planting season.
Yep.
It is a real problem, and it's coming to a head.
Yeah, and the U.S. does a good job of ordering ahead of time. But one of the main countries is Brazil, which is a big agriculture farming country. And they get a lot of their fertilizer from Qatar and Middle East.
And it's more on demand. They're not as far as ahead. Like the farmer who's farming my dad's land for him says he's okay for now. The diesel prices are affecting him. But other than that, the fertilizer hasn't hit him yet, but it could if it goes on too long.
If it goes on, you start to think about 2027 planting season.
Yep.
So needless to say, there's a lot of things going on in the markets that there was a reason for the correction with the uncertainties, because higher prices lead to consumers spending less wallet share on the discretionary goods.
Yeah.
So the reason I'm not all that surprised on the snapback is you also have to look at the companies that drew us down, which was the mega cap tech names was a big reason for the drawdown. So you have companies like Broadcom, Google, Meta, NVIDIA, Microsoft. We're all in a 15 to 20% drawdown because of the concerns over AI and the spending on AI. And does it actually give you a return on investment? So the reason for the snapback, and I'm not surprised, is coming into the year, the market keys off of earnings growth for the aggregate S&P 500. I'm using S&P 500 as the market. So coming into the year, the earnings expectations for year-over-year growth was 13%. Now, when you start to have headwinds of oil, fertilizers, food costs, everything that goes into what consumers buy, the initial reaction is that there's going to be a headwind to these companies. because they're going to either pass it on to the prices on to consumers, or they're going to take the margin compression themselves. That's between AI and the margin uncertainty for companies was the reason for the drawdown. What's actually happened since is earnings expectations. So the Wall Street goes out and talks to the companies and says, what are you thinking for earnings? Here's my model that I've forecasted out. Am I in the ballpark? And companies come back and say, yes, no, close, whatever. So they talk with the PR teams or IR teams quite a bit. What's actually happened since the beginning of the year is earnings expectations have gone from 13% to 18%, which is very abnormal. Usually what happens is you come into the year, earnings expectations are 13 to 15%, and they tend to fall right around the historical average of that 8, 9, maybe 10% on a good year. That's the normal trajectory. So we're going in the opposite direction, which is why you started to see the snapback. Is not only do you have AI companies continuing to spend, right? It's CapEx, so it's committed capital at this point. Like it's a commitment, not just a speculation. And there's certain companies that had the drawdown that allowed that spend to continue and benefit from the CapEx spend. But now you have potential ceasefire deals. I know the news is saying it's on, it's off, it's on, it's off. And I think that will continue for a while. But we now have oil prices sitting back down around that $80, $85 a barrel, which is more manageable rather than 110.
Yeah.
Right?
Yeah. It ticked back up just today, but it's still not great, but you're right. It has ticked down. I was just shocked, like you said, Jose, that when you saw that, we hit record highs. And I'm like, in the midst of all this, but really what the stock market, it shouldn't be about what our president says or what Iran does or the Strait of Hormuz. It should be about product,
are these companies making money?
Yeah, it's the earnings. Yeah.
So companies are very good at shifting costs around.
Yeah.
And so that's why you started to see, now that you have oil coming back down, they've probably already shifted some of their capital around to be more, I don't know how to say it, more doing a better job with their capital. We'll put it that way. So you have the ceasefires now, or maybe, but oil coming back down, you have solid earnings growth. Consumers continue to spend money. We're Americans. We love, as soon as it comes in, it goes out. So that will never change. So I think that is the impetus of the snapback. And then you also talk about valuations for the market, which have come down because it's a inverse relationship. When you have earnings going up, stock market going flat or down, your valuation comes down.
Right.
So
true.
We've been at an elevated level for probably the last 2 years. We've been above the 10-year average. Whereas now you're kind of sitting right at that 10-year average. So you have cheaper valuation, which is good. Obviously you want it as cheap as possible, but sitting back at the 10-year average is, we'll call it fine.
Healthy, would you say?
Yes and no. I would say healthy would be a little bit cheaper.
But we're going the right direction regardless.
Correct. And then you have strong earnings growth and a healthy backdrop of the economic growth, because the economy, despite all this, the expectation is for about 2.3%, which is kind of in line with the 25-year average for economic growth. So all in all, it's really not as bad as the...
Yeah. And even Jerome Powell, I think, brought it up and because a lot of people were concerned that he was going to bring interest rates back up because of the inflationary effects of the increase of oil prices. Right. But even he said it himself, this is just temporary. We're not really building that in. Considering this, because he kept interest rates the same. Now, so what I think, at least from my understanding of what came out of all these things, is we got this correction, we came out of it. Valuations are coming back to a little bit not as expensive, because a lot of people were calling me just asking, oh my gosh, the market is overvalued and so expensive, right? And that was a concern, but now that's looking a little bit better. And also there's more of the growth in the market is not being led by the top 7 anymore, is it?
Yes and no. I mean, you're seeing a broadening out. So you're starting to see small cap stocks work. You're starting to see, I mean, international worked last year. Some of that was the tailwinds from the US dollar. declining. But generally speaking, what we were looking at and why we thought mega cap tech and the Mag 7 could come back is these stocks, the companies themselves, their earnings are growing at a significantly more rapid pace than the overall market. So when you have a higher growth company and with the data center build out, you actually have more visibility into their earnings growth right now because there is a backlog of data centers. So you actually have more visibility, plus which means that you know that they're going to have better growth than the overall market, but they're on a valuation perspective, they were trading cheaper than the market, which would signal to us that's a good buying opportunity because like Broadcom's ASICs division, which is their custom chips that we've been hearing about for the deals, like their earnings or revenue growth for their ASICs division was 70% last quarter, and it's expected to continue at that pace for the next year or two as they add on more and more clients. So that's why mega cap tech has worked so well in the past, and it will continue. I think it will continue to work going into this year and next year is because of the visibility, the growth power that the companies have. And now they're not even trading at that expensive of a multiple for valuation.
They're still not trading very expensive. Is that?
Nope.
Interesting.
And then also, if you even look back at the last couple of years, and when you think about the S&P trading at a 22 times, 10-year average is like 18.5. If you split out the Magnificent Seven from the rest of the stock market was actually trading in line with its long-term average of about 16 times.
Wow.
So S&P X, the Mag 7 was still very fairly valued. So you just have to strip out the high growth stocks that carry the big multiples that now account for a significant portion of the S&P. And there's still a lot of good opportunities out there.
Yeah. And so from what you're saying, maybe the digital discovery is still a good opportunity to buy. Is that what you're saying?
That portfolio is a very volatile portfolio. I'll start with that.
Okay. I know.
So there's risk involved, but the potential
Yes.
upside is great.
Yeah. So I mean, I use standard deviation as like the riskiness of a portfolio. So S&P 500 standard deviation is around 16.5, 17%. The digital discovery is about 46.
Oh wow. Okay.
Right. So you're talking 3x, and you get different return streams, right? Because you're focused on crypto, you're focused on blockchain, AI, metaverse, quantum computing, and more recently we added some space into it.
Wow.
But it's just all these newer technologies, newer things to invest in. So you're gonna get the volatility. So if you think about it from a long-term perspective, I still really like the portfolio. Short-term, when you have these spikes in oil and ups and downs in the market, you're going to feel that quite a bit more. So there's going to be the volatility when people want to go what I call risk off, meaning they want to be in safe assets only, like U.S. Treasuries, gold, the U.S. dollar, whatever it is. When you want to be in that trade, the digital discovery is not a good portfolio to be in because you'll feel that in your account.
So Jose, when you're working with your clients, it really, we're not recommending something for, across the board. That's why it depends on each person's situation. It depends on when they're going to need that money. So what would you tell your client? You've got this great portfolio, digital discovery, but you might have a client where, hey, we're not going to need this money for a long time, or this is leave to our kids. Maybe that's the direction you go. Is that right?
Yeah. It's definitely the digital discovery is definitely not something that we recommend all the time, but it's gained a lot of popularity, and that's why it brings up a lot of conversation. But
if you're younger, like if you get a younger couple in there, you're like, hey, you're not going to touch this money for a while. You might want, if you want a little more risk, to try to capture some growth.
Yeah, and I usually just compare myself.
More risk, more reward. Right.
Yeah, I compare myself as, I am young, and I have 20, 30 years to come back from this drop. Most people in retirement, they don't have 10, 15 years to come back.
Sure.
Because they're drawing down on their money.
Or if you're in a risky one like that and you don't want to try to time the market, but yet when it has a great year, and it's up 124% the
Yeah.
first year. Tyler touches his first portfolio. It's like the first year. What did it do?
106%.
106%.
Yeah.
So you might want to. That's why we have you here, as Jose,
Mhm.
and you can go in and say, let's cash in on some of those gains and
Yeah.
rebalance. Right. That's when you rebalance your portfolio.
Exactly. But one of the things that I also found really interesting from all of this comeback, and I'm looking at what Gradient Investments just put out maybe just an hour ago on the just the weekly data,
Mm-hmm.
and I'm looking at the year to date Russell 2000, and it's pretty close to what gold has been doing this
Yep.
year to date. Which
Yeah.
is pretty interesting. So
As of the recording of the show this morning, I always laugh at the Russell because it's like the redheaded stepchild to
Yep.
me.
yeah,
Everybody looks at the S&P, and before that, it was always the Dow. Everybody's heard of the Dow, but the Russell 2000. It's so funny because a lot of times, like today, you see a negative on the Dow, you see a negative in the S&P, and for a while today, the Russell was up and it was headed up, and I'm like, how does this Russell? And then the Dow's having it hits a record high, and the Russell's down, and I always get a kick out of the Russell.
Well, I think the Russell's also fundamentally different than it used to be back in probably before 2015, 2016. And the reason I say that is, so the Russell 2000 is small cap stock. So the market cap, depending on who you ask, is usually about $2 billion market cap and under. So what's changed is private equity. So private equity finds these companies ahead of time, the unicorns that tend to drive the small caps, like Netflix, Amazon, even Apple at one point. Like all those small companies would have been in the Russell 2000
at one point,
and would have driven the index higher, because then they slowly make up more and more percentage. And then as soon as they get too big, then they get put into the mid cap space. Now private equity is holding on to these companies until they're a 15, 20, $30 billion market cap size, and then they bring them public. So you have a fundamentally different Russell 2000. But Russell 2000, the earnings expectations for small caps this year, last year was negative. This year is about 65% growth.
Wow.
Jeez.
So if you think about broadening out and potential, obviously there's a lot of needles in the haystack there, just because about half of the Russell 2000 isn't profitable.
Right.
So watch out for those.
But this is what you've been telling us, is that it's spreading out. Like you asked about the Magnificent Seven. Now you bring up the Russell 2000 as the smaller cap stocks, and we're starting to see some.
Yeah. And then from your gold standpoint, so typically when you have these times of war, you tend to see people flock to real assets like gold. And so gold tends to perform well when there's times of uncertainty, geopolitical risk, and it's done the exact opposite when the Iran-US war started. So last year, I don't know the exact return of gold, but it was pretty significant.
It was huge.
Yeah, it was like 70 or something.
Yeah.
But then what was different about this is a oil battle right now. And you're blockading 20% of the seaborne oil supply. And so countries still need to get their oil. Manufacturers need it, countries need it. And so what we saw happen was, instead of people flocking, countries, central banks flocking into gold, some retail investor flows came in. But what ended up happening is, in order to get your oil, you need dollars, because most of the oil trades in dollars.
Right.
And so if you need oil, you need dollars. And so the trade wasn't to go into gold, the trade was to go into US dollars, which is why you saw the dollar strengthen despite the Iran-US war happening, because there's just more demand for it. And when you're trading more in US dollars, your central bank needs to hold that dollar in reserve, or a treasury, or some type of US backing currency. So that was the trade that you saw. Instead of going into gold, you saw people flock into the US dollar.
Yeah, and to do a little quick plug-in on talking about the small caps. Now we have a portfolio, because you remember you said in the Russell 2000 there's only half of it is not profitable, right? So just buying the index is not necessarily maybe the most efficient way to do it.
No.
So now we get into maybe stock picking and building an actual portfolio on this space makes most sense. And now we have that, right? So can you talk a little bit about the new portfolio we have?
Yeah. So we've had a long relationship with a guy by the name of Brian Belsky. If anybody watches CNBC, he's on there quite a bit. He's a great personality.
He is. He actually makes finance interesting.
Yeah. And he's out there with his calls, and he's been right a lot of the time. But he's been a good friend of our firm. Mike Binger, our president, has known him for probably 15 or 20 years. And so when it comes to small and mid caps, there's so many stocks out there. And rather than our team try and put something together and just eat up the amount of time we would need to research the small cap stocks, Brian Belsky, is one of his specialties is small and mid cap stocks. And so he ended up starting his own firm, breaking away from, he was the chief investment officer at BMO Bank, and I believe Morgan Stanley before that. But he broke away, started up his own RA firm so we could actually partner with him at that point. And so because he's been so stellar in that small cap and mid cap space, we asked if he would be a sub advisor on one of our portfolios. So our SMID Cap Select is what we launched, and Mr. Brian Belsky gets to be the manager on it.
It's called SMID Cap, small to mid cap is what you're talking about.
Yep.
That's great.
Yeah. And how's it doing this so far since it opened this year?
It's been okay.
Mhm.
I don't know what the return was as of yesterday or as of Friday. But it's had its fits and starts. Stock picking, you can't always be right, unfortunately. But he's working on it.
Yeah. I mean, it's like anything else. I mean, the G50, a lot of these, they'll adjust them as they go. And I think it's the smart direction, though, from everything you said, Belsky said.
Oh, yeah. Belsky is such a personality and such a, I feel honored to even say that we have Brian Belsky helping us out on the portfolios. I bring it up all the time when I talk to clients. Yeah. And I make them look him up on YouTube because he is interesting.
He's very well respected because he really knows what he's doing, and he's one of the smarter minds, and his track record speaks for itself.
Yeah, it really does. But yeah, I mean, today I really wanted to just, I think, give information out there, educate our clients, because in the time of freaking out or when things are going on, I feel like the more we educate our clients, the better they can make decisions, because they're not, making erratic choices and then hurting themselves. So this is what I wanted to do today, and I think we just had a really good discussion to educate the clients. And I love
one more thing that I'd throw out there is, so the market pulled back about 9% from the highs. So the average correction in any given year, the average is about 10%. So if you take the average and say that the market is up total return wise 11 to 12% over the last 50 years on average, throughout the last 50 years, during those plus 11 and 12% years, you've also had a 10% drawdown or correction.
Yeah.
Despite still finishing the year up 11, 12%. So it's not abnormal to see this. It just, we forget about it, and nobody likes to see their accounts go down.
Right. And coupled with the geopolitical news that's just like been intense and serious, people panic, right? They let their emotions take over. But Jose, that's where you come in. You help keep their emotions in check and say, no, we have a plan. We'll get a plan. We'll stick through it. You're balanced. You're allocated. You don't need to worry about market volatility.
Yeah. I mean, this is the perfect time that I love. This is where we shine the most, in my opinion, because people usually call and then, they're freaking out. And then I show them, well, look, you actually haven't, because we set you up so good that all this craziness, it actually is not really affecting you that much, because you're right. You're allocated towards your actual risk tolerance, which is where we spend a lot of our time understanding people's risk tolerance. So when
if you're
all these craziness happens, they're not overreacting over it.
And if the market goes down and you're still in your working years, you want a correction, because You're dollar cost averaging your way in. You have money coming out of each paycheck going into the market. That's great. The down times are how you make money, and then you catch the upswing. So before we go, Jose, our listeners out there, they need a plan. You need to be working with a financial advisor, especially during these times. How can they get a hold of you to set up that no charge, no obligation consultation?
Yeah, they can give us a call at 888-390-5277 or go to our website, cooperfinancial.com.
All right. Well, great show today, guys. And thanks to our very special guest, Tyler Ellegard, Senior Portfolio Manager over at Gradient Investments. And of course, our amazing host, Jose Rodriguez. Jose, great show today, buddy. A lot of great questions and great answers from Tyler.
Thank you very much.
All right. And that does it for today's episode of the Financial Armor Show. Again, with our host, Jose Rodriguez.